As returns on MMFs continue to fall, what are the alternatives? One of the questions our readers have been asking, especially guys who put their money in MMFs, is what are the alternatives, or where can we combine our MMF investments for optimal return? So today we are going to talk about I-REITs, and these are income real estate investment trusts. Just like MMFs, they use the principle of collective investment, and the only difference is with an MMF, investors like you and I, we pool our resources together and we hand it over to a fund manager who then invests the money in short-term and low-risk investments such as T-bills and commercial papers. Now, I-REITs, on the other hand, investors like you and I, we pool our resources. You contribute 5K, I contribute 30K, and the money is pooled into one pool, which is then run by a professional fund manager. They are licensed by the Capital Markets Authority in Kenya. And this money becomes a trust that is professionally administered with the purpose of owning income-generating property. You could have a building that's worth 1 billion shillings, and the REITs manager issues 50 million shares, which are bought by different people at a rate of 20 shillings. Each person buys the number of shares based on their ability. Someone buys that are worth 2 million, that are worth 50K, and then in this building now you own a share that is equivalent to the amount of money you have contributed. The primary goal should be to generate rental income. So regulations in Kenya dictate that the REITs manager has to issue at least 80% of the revenues collected in the form of dividends to the investors. So one of the major differences between I-REITs and MMFs is that I-REITs will most likely give you a proper return when you have invested in the medium or long term, unlike an MMF where you can keep your money for maybe 2 months and then you withdraw. So an I-REIT will give you an optimal return when you have kept your money there for about 2 to 3 years. And this is because one of the major benefits of investing in real estate is because of capital appreciation. Besides rental income, capital generation is where the building that we gave the example having a value of 1 billion, if after a year it's worth 1.1 billion and the number of shares issued remains the same. So once the value of the property increases, the value of your shares also increases. So if the value increases by 100 million and there are 50 million shares, then each share then increases by 2 shillings. So if you had bought at 20, now it becomes 22 shillings. And this is still when you're getting the rental income. However, in terms of liquidity, MMFs as well as I-REITs have almost the same level of liquidity, because since you own shares, then you can get someone else to buy the shares, or you can even sell them back to the REITs manager. Usually within a period of a few days, you can be able to get your money back in situations where you need the money. In terms of returns, one of the benefits, as I mentioned, is you'll enjoy capital appreciation as well as rental income, which then compounds it and could even offer you sometimes higher returns than what MMFs are offering in the market. However, the rental income will vary depending on the REITs manager's portfolio. So some REITs manager invest in property that has higher rental income or higher rental yield compared to others. So that may vary from one REITs manager to another. And of course, both are low risk investments. Once you have invested in an I-REIT, you have invested in a physical building. Many of the REITs managers will even let you see the physical buildings and you can visit them. So those are low risk investments, just like MMFs. Money254.co.ke has written extensively about some of the investment options in Kenya, including some of the alternatives to MMFs and other vehicles that are available in the Kenyan market. Click on the link provided to learn more.